people or viewers who are drivers themselves or who have seen other people driving know this fact that most of the time you see what is ahead of you, and only occasionally you look at the rear view mirror when you want to change lanes or things like that. In investing, what happens is people focus only on the rear view mirror and don't look at what is in front of them. Just being guided by past behavior, either of a asset class or of a market segment, like you mentioned, small and mid caps, that is a dangerous way of driving your investments. What has worked is largely staying disciplined and staying through the ups and downs in the market and having a meaningful equity exposure. Earlier, I had bank FDs plus liquid funds, and now it is bank FDs plus arbitrage funds. So the liquid fund investments have moved to arbitrage. The way I look at it is, if one continuously keeps upgrading the lifestyle, then no amount of money is sufficient. So I've largely kept the goalposts constant. So it's not that I aspire to have a private jet or 10-15 story bungalow of my own or anything like that. So given the lifestyle that I lead, I have sufficient corpus to see me through in retirement, I hope.
It's not easy to stay calm and steady, especially when markets are extremely volatile. In this episode of Guru Portfolios, we have with us Rajeev Thakkar, who is one of the top-rated fund managers in the country and oversees investor assets worth rupees 60,000 crore. Hi Rajeev, welcome to the latest episode of Guru Portfolios. So Rajeev, we'll get straight to the point. What's your current asset allocation mix?
My asset allocation is largely equity heavy. So I would think if we exclude the residential house that I live in, about 95% of it would be in equity-related asset classes. Some of it in our mutual fund schemes and some of it in the company that I work for.
Okay, and what about the balance, 5%?
Roughly 1% would be physical gold, which is in the form of jewelry, which traditionally we have for weddings and gets passed generation to generation. The remaining 4% would be in various asset fixed income securities, which are part of the emergency corpus, or which is FDs and arbitrage funds and those kind of investments. And some of it would be the retirement funds that are there, EPFO, NPS, those kind of assets.
Rajeev, if you can give a split of your equity, you said also some of it is in your own company, Parag Parikh Mutual Fund. So how is that split?
Broadly, it would be 1/3 would be the mutual funds and roughly 2/3 would be in the company shares. But again, just to give context for people viewing this, those are illiquid assets, difficult to value, difficult to enter, exit. So from a financial planning perspective, the mutual fund units are what matter rather than those.
About your concentration on Parag Parikh, both through unlisted and mutual fund, how has that come about? Did you also went out and bought some additional unlisted shares of the company?
Two things to keep in mind. One is, when we invest in a mutual fund scheme, we're anyway investing in 30 different stocks. Holding one single mutual fund scheme is not as risky as it seems. Like owning a single company. Again, if someone has a Sensex index fund, one would have 30 companies in the exposure, or if one buys a Nifty 50 index fund, one would have exposure to 50 stocks, and that is diversified. That is not really that concentrated. And the exposure to our company shares, again, while it may seem high on the perceived value or something like that, but largely the cost basis would be very low. So these have been bought maybe 15-20 years back, and it has been built over a period of time. So I've been working in this company since 2001, so over a period of 23 years. Some of them really go back 2 decades. So really looking at the current value may not make sense. So it may be misconstrued that I've written out a check for a big amount. It's really, some of them would have been bought at par 2 decades back. So.
And what about alternates? Because Parag Parikh mutual fund as a fund house does track unlisted space as well to get a sense of the unlisted market out there for the companies that you're already owning in the listed space. So do you plan to also invest in alternates?
No plans as of now. So some of the companies in that space are interesting and one tends to track that. But as of now, neither the company has any offering in the unlisted space. So we don't have a PE or a VC fund or angel fund, that kind of a fund. And neither do I have any personal investments apart from the one stock that I own.
And what about real estate? Do you look at real estate as a investment proposition as well?
Real estate is a very interesting asset class, especially the income generating part, the commercial real estate kind of thing. Of course, globally it's going through its own cycle and it's going through tough times where a lot of people haven't returned to office post-COVID, and commercial real estate has been under stress overseas. But in India, it's been doing reasonably well, and that is something that we track. We also own REITs in our conservative hybrid fund in PPFAS. So yeah, we track it, and it's an interesting mix to add to the overall investments.
And Rajeev, how did your portfolio perform on an overall basis over the past year?
So again, equity, we generally urge people to look at it over a longer time frame, but past 1 year, it would be roughly 43% or thereabouts.
And Rajeev, again, back to your equity, what's the split across large cap, mid cap and small caps?
It's largely in flexi cap. So the flexi cap weightages would be applicable. So bulk of it would be in international stocks plus Indian large caps with a small allocation to mid and small caps.
Which would be what, 80-85% in that range?
Yeah, so 80-85% would be in the larger companies. Yes.
And how much of your portfolio is in international stocks?
15% is in international stocks. Yes.
And Rajeev, for you, what was one big miss over the past year, and also what worked for you?
Miss has been more driven by the environment where funds have been constrained by the regulators in terms of remitting money outside. And in 2022, there was a big dip, late part of 22, early 23 kind of thing in foreign stocks, and some of them were really attractive to purchase. One couldn't increase exposure, but nevertheless, it's good that we have the exposure that we have. And what has worked is largely staying disciplined and staying through the ups and downs in the market and having a meaningful equity exposure.
Rajeev, what about contingency fund? Do you maintain a separate contingency fund, and how many months of provision does it have?
So I maintain investments in debt securities. So as I mentioned, roughly 4% is in fixed income kind of securities. So that is sufficient to cover 2 years plus kind of expenses. So it's something which is at a reasonably comfortable level, and again, part of it can be used to meet medical needs over and above the insurance covers that I have.
There were changes in debt taxation in the last couple of years. So have you kind of rejigged that portfolio a bit?
Earlier, I had bank FDs plus liquid funds, and now it is bank FDs plus arbitrage funds. So the liquid fund investments have moved to arbitrage.
If I remember correctly, and we keep having these conversations in the past, that your contingency fund had come down a bit to a year's worth of provision. Can you share for our viewers, why this was, I think, in 22? What was the reason behind it? And now, of course, it's back to where it was.
Typically, people have contingency fund for 6 months worth of expenses, and I tend to keep it a bit larger. So part of it can be used opportunistically to use if I need to deploy money somewhere, and some shares were available for our company. So it was used for purchasing those shares, and it's back to the 2-year kind of levels.
Rajeev, also, what about insurance? What about your health cover, life cover? How much of that you have?
So life cover, the way I see it and the way generally financial planners recommend is, it is to meet a contingency where the primary wage earner does not have the capability of providing labor and services to earn a monthly paycheck or something like that. So typically it is used when the dependents are younger or dependents don't have earning capability where savings may not be sufficient enough. So given that I'm in my 50s, the life cover is now probably there for another 4 odd years, and my daughter has become a major. She will complete her education soon. So life cover is there right now in terms of a term life insurance policy for me and my wife. That will lapse in 4 years, and I don't plan on getting an extension. In terms of health cover, so both me and my spouse work in the formal sector, and we have a coverage through our employer. So that adds up to roughly 20 lakhs for the family. My parents have their separate covers. And apart from that, I have a 3 lakh personal cover. So total about 23 lakhs per health insurance.
And Rajiv, what about your family? How involved they are in your investment decision?
The decisions are left to me largely, but they are very well aware of what is happening, and they understand investing as well. So my wife works in the mutual fund space. She's in the risk department of another fund house. And my daughter is in a different stream. She's into engineering, doing computer science, but she's aware of investing and what all is involved. She reads investing related books and attends our mutual fund AGMs and has been to Berkshire meetings a few times and things like that. She does her own small investing for whatever surplus she has, largely investing in her own funds. She's aware of what is happening.
And she's still studying, so how old she would be?
She is 20 right now.
So has this come just from her, or have you had to play a role in imparting the investing acumen and the keenness towards investing?
She's a curious person, so she's been interested in various areas, and investing is one of them.
And Rajiv, what about your retirement kitty? Have you reached, or are you far from reaching your retirement corpus target?
The way I look at it is, if one continuously keeps upgrading the lifestyle, then no amount of money is sufficient. So I've largely kept the goalposts constant. So it's not that I aspire to have a private jet or 10-15 story bungalow of my own or anything like that. So given the lifestyle that I lead, I have sufficient corpus to see me through in retirement, I hope.
And Rajiv, we know you are a voracious reader. So what are you reading these days? Anything you recommend our viewers, that something they can pick up for the weekend reading or anything like that?
So I've been following Ms. Rama Bijapurkar for her insights into the Indian consumer behavior. So I've read her earlier 2 books, and her 3rd book has recently come out. So I just started with that. It's called Lilliput Land, and it's about the behavior of Indian consumer, the recent insights, especially in the post-COVID period. So I'm liking it so far. It's an interesting read.
Right. And Rajiv, before we let you go, can you share what's your one big advice for the investors who are watching us right now, given the way markets are shaping up, the volatility on mid and small cap space that we saw recently? What would you have to tell our investors?
People or viewers who are drivers themselves or who have seen other people driving know this fact that most of the time you see what is ahead of you, and only occasionally you look at the rear view mirror when you want to change lanes or things like that. In investing, what happens is people focus only on the rear view mirror and don't look at what is in front of them. Just being guided by past behavior, either of a asset class or of a market segment, like you mentioned, small and mid caps, that is a dangerous way of driving your investments. There is some body of knowledge which has evolved over a number of years, which talks about evaluating your risk appetite, doing a proper asset allocation, being disciplined in investing and staying the course. I think that is more important rather than trying to tweak the portfolio all the time and moving to the asset class which has given the best returns last 1 year or last 3 years. I think People should be mindful of that.
Thank you so much, Rajeev, for joining us today and sharing all those insights.
Thanks, just pleasure talking to you.
Hope you found this conversation insightful, and we'll be back with another episode pretty soon. So stay tuned on Mint.